The Supreme Court did not rule on Trump's tariffs. That's having some impact on the market, but a lot of stocks that are moving might be moving for other reasons. That includes some of the money center banks, and we're going to talk about that and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So on Monday, one of the questions I was asked about was whether or not I favored selling a put spread going into JP Morgan earnings. Now, JP Morgan, as it happened, announced earnings. They did so yesterday, and they did so before the open. This was something that we mentioned that they were going to do, so that even as we opined on that trade, we weren't really able to make an actionable recommendation on it. That is to say that if the person who was asking the question already was in the trade, there was going to be no way to close it until after the earnings number had already come out, and there would be no way for anybody who was watching to enter into the trade, again, because the market wasn't going to be open until after we already knew the results. But the short version was that I had simply articulated one of the reasons I wasn't enamored of the idea, and that was that it was the sale of a $10 near-dated put spread that expired at the end of the week for a relatively small percentage of the distance between the strikes. And my point was that although the trade historically had a relatively high success rate, if we looked at past earnings, so I looked at 11 years worth of past quarterly earnings results. JP Morgan typically does not move very much when they report. And the move this time, although it was negative, wasn't huge. I think it initially moved about 3.5%. It did continue a little bit lower today. And the issue that I took with it was simply this, and that is that when we enter into options trades, especially options trades that are short premium, we are taking a form of equity-like risk. And in exchange for that risk, we hope to earn an annualized rate of return that is, commensurate with what you expect to make for investing in equities. And recently, at least, the return on equities has been quite good. I tend to use a longer-term historical rate of return as my, essentially as my basis for assessing whether I think a trade is reasonable or not. So over the last several years, of course, the rates of return for the S&P 500 have been very strong. 2025 was about 17% for the S&P. The prior 2 years were higher than that. But I think if you used 12% as an annualized rate of return, that's a reasonable rule of thumb. And by that metric, the sale of that put spread was actually calculated to return about 8.8% on a standstill basis. So by selling that put spread, if you wore it to the end of the week, the annual rate of return relative to the price of the stock was about 8.8%. Now, as I said that, one thing I think I should also add is that this was selling a put spread, not just an outright put. And if you think about it that way, and so this is sort of giving more benefit of the doubt. Let's queue up a similar trade, or actually we could probably even just build the one that was being discussed for anybody who. Well, I was just doing a little bit of math on strategy stock there, but let's take a look. So I believe the trade was the 315-305 put spread that expires at the end of this week. So what we're going to do is we're just going to drag those options in. So the 315 puts and the 305s. And we can just take, you know what, I'm actually going to do it this way. It's probably better. I'm going to put these in as columns, and then we'll just take a look at their respective midpoint prices as of the close. So I don't know when the person who asked the question actually entered the trade. Why don't we assume it was, so Monday was the 12th. Why don't we assume it was Friday? That was the 9th. So we'll start with that. I did that correctly, I hope. So what we're going to do now is we're just going to take the midpoint prices for that instrument. Whoops. Oh, I got to... Certainly didn't need to do that. I went all the way. I meant to put 2026 in there. So I got a lot, way too much data. Instead, why don't we just do this? There we go. Otherwise, it's just going to be too much to look at. For our purposes, this is really not, a lot of history of just a couple arbitrary options isn't really the point of this exercise. And okay, so this is the closing midpoint prices for the two options that were posed in the question. It was the January 16th regular weight, 315, 305 put spread. I'm just going to use the midpoint prices. Why not? Again, for our purposes, not going to make that much of a difference. This is the price of that spread over time. It was about $1.56 as of Monday when we were asked, do I think it's a good idea to be short it? And I said, not really, because $1.56 over the course of 5 days relative to JP Morgan's stock price, which is, in round numbers at the time, I think it was like $320, didn't seem like such a terrific bet to me, even though, and I'll bring this in here, if we looked at JP Morgan for the last 11 years, and remember, this was asked on Monday, and there was 3 days to go. So basically, it was from 1 day prior to 3 days following earnings. And we can see what the results were, right? And we can see that this thing hasn't really moved that much. It's had a couple moves that are fairly big, like this one over here when they reported their Q1 2024 results to the downside, right? Here's another one. This would have been max loss, max pain, if you think about it that way. This one obviously would have been as well. But in general, whenever it's flat to higher, this is a trade that would have been profitable. And as it turns out, that's most of the time. So that's fine. Now, when I described the rate of return, what I was doing was I was just simply saying, okay, well, you're getting $1.56 divided by, we'll call it a $320 stock price, which is 48 basis points, round numbers, over the course of 5 days. So it's really equal to that. Times, 365 divided by 5, right? Or something like that, okay? So this is, did I do that math correctly? Or actually, yeah, something like that. The point I would actually make, though, here is that when you're selling a put spread, and this is something that I think we really need to think about when we get into short options, that it's fine to think about rates of return in equity-like context, but we also have to consider probabilities. And what I mean by that is that if you bought JP Morgan, and it has, we can sort of take a look at its returns, the chances that this goes to zero, that it is virtually nil, right? So the chance that it goes, these are standard deviations. So this is down 1 standard deviation, this is down 2, and we probably can't even make it out down 3. Meaning that, you have to also kind of risk adjust your rates of return to think about the probabilities that you're going to experience the maximum loss. So the maximum loss in this particular case, you were making $1.50 in round numbers. You could lose $8.50. As it happens, I think we're not far off of that now. Let me just pull this up. Well, let's see here. So it's worth, right as of today's closing price, it's worth $6.30. I guess that makes some sense. We've still got a couple more days to go. But obviously it's lost more money than it could have made in the best case. And this isn't even that big a move, right? What we're talking about here is a move down to 307, 308-ish from 320-ish. Let's call it 307 versus 320. So the stock's down 4% over just a couple of days. Bigger than it typically does move for earnings, but it's worth noting that that's something that you have to think about, which is not just the probability of loss and not just the rate of return relative to the stock price, but also what the probability of max loss is. And in this case, the stock only needs to decline another $3 by Friday, which is how much it's down today alone, by the way, for that put spread, if you didn't close it early, to get to max loss. Which brings me to another point, which is in a situation like this, does it make sense to close the trade early and move on, or should one wait and see? Well, here's the thing. At this point, this trade, actually, time is not on your side. So this thing is, it's worth $7 at intrinsic, slightly more actually. $7.13 is the intrinsic value. And what that tells you is that if the intrinsic value is higher than the market price, that means that the price of this thing is going to rise over the course of time, which means time is not on your side. If the intrinsic value is less, then time is on your side. So what do I mean by that? So the 305, 315 put spread, if this thing was trading at exactly 310 and the put spread was $5, that means time has no impact, right? It's $5 in the money. It's priced at $5. As time passes, it's going to converge to that $5 price, so no change. If the stock is at 305 and that put spread is priced at $5, well, at 305, it's going to be worth 10 at expiration. And that means that as time passes, the price is going to move from $5 up to 10. Time is not on your side. Now, if the stock was trading 320 today and it was still trading $1.55 or $6, wherever it was on Monday, time is on your side because it's out of the money and eventually it has to converge to its intrinsic value. So my sense is that if you get something, if your thesis is that the stock is going higher and instead it trades lower, you can decide for yourself at that moment, is this an unusual circumstance? Is this idiosyncratic related to something that happened that day? Or is this something that means I have to reevaluate my thinking? Well, by today, not just JP Morgan, but also Citi and Wells traded lower. And the reason they did so, because all of their earnings results were fine, the reason they did so was partially because of this statement that President Trump had made, saying that he wanted to cap credit card rates at 10%. So a couple of things about that, because it relates actually to a question that we got. The first is, am I in favor of capping credit card rates at 10%? I'm not generally in favor of government price controls and regulations over corporations and consumers and the balance that they strike. So at a high level, if I'm not in favor of government price controls, then I'm not in favor of rate caps because that's a form of price control. I will also say, though, that I do think a lot of consumers end up taking on these kinds of revolving debt at onerous rates of interest. I hesitate to say even almost usurious rates of interest. And they can get themselves into real trouble. So it's one thing for them to have access to that kind of a facility on a temporary basis where the compounding effect is not that great. And put differently, if you have that rate of interest and it helps you carry from 1 month to the next, for 2% of the amount borrowed, 2.5% of the amount borrowed to be able to carry it for 30 days, maybe that really helps your liquidity, and that's helpful. But of course, for people who carry balances on an ongoing basis, it's almost impossible for them to dig themselves out of this kind of trouble. So I do have, I do take issue with it. I think that's probably the responsibility of consumer education that needs to improve, and just taking a look at the things that surround it. So I'm not in favor of that, But that was the reason that the stock continued lower today. So if you're in this situation where you are short this put spread, the put spread's time is working against you, and you have both of these things working in concert with one another, my inclination would be, on a standstill basis, the situation's only going to get worse. So, as soon as you see this, cut your losses and move on. And this also is a trading theory in general that is kind of an old saw of investing. Cut your losses quickly and let your winners run. So I just had that observation. Now, the reason I bring this up was because somebody then asked the question, and I don't have it in the social media chat, but maybe, here we are. Yes, good. So Carmel Muse said, how does JP Morgan compare to Goldman for a better investment? Now, my thinking on this is when we consider what hit JP Morgan, what hit Wells Fargo, and what hit Citi, one of the big concerns was this credit card rate cap. Now, there is a card that JP Morgan, do I have? Yeah, so there is a card. I don't even know if I happen to have one on me. I think I do. That Goldman Sachs issues. Do I have it in here? Let's see. Maybe you guys will recognize it. I barely ever use the thing. Is it in here? Is this it? Yes, here it is. One of these. Well, yeah, I can show it to you because one of the novel things about this credit card is that it has no numbers on it. I don't know if anybody can recognize it. It's just basically white. And if you can't quite make it out, right up here, it says Goldman Sachs. Well, it's not going to say Goldman Sachs much longer. It is instead going to say Chase or JP Morgan. The reason? These cards, this is an Apple card. Goldman Sachs is getting rid of that. They decided this is not the business for them. They're not a consumer credit company. And so that is going to migrate over to JP Morgan. So I actually think that in this context, that's good news for JP Morgan. What else is good news for JP Morgan? Volatility is good for JP Morgan. They make a lot of money off of trading. And, generally speaking, when things are a little bit more volatile, their profits tend to go up. And Goldman Sachs doesn't lose too often. I think I remember reading in one of their annual investor reports, their annual reports, that they counted the number of trading days where they had lost money. And it was less than 10 over the course of an entire year. So higher volatility, because they make markets and do things like that, it's generally pretty positive. So let's just take a quick peek at what Goldman is valued at. And, here we can just do a little bit of quick arithmetic. So they're forecast to make about $56 a share next year. We'll call it $9.33. So they're trading 16.7 times next year's estimated earnings. And for perspective, we're looking at a 2-year number, but that is higher than they have been historically over the last 5 years. But in some ways, that's not that surprising because, a lot of these things got very hard hit coming out of the pandemic. If we look at the more recent number, my guess is that it's going to be, actually, it's still closer to the upper end of the range, higher than I had thought that it would be. But you can see some other multiples where they compare to the competition. So 2.6 times book. We would like, generally speaking, to try to get those things down on a tangible book basis. If you feel like if you're getting it at 1, you're getting a bargain, right? Because effectively you're buying it for its pool of assets. And I don't know that you're ever going to get quite down to that kind of a number. You can in the case of Jefferies. Jefferies has been hard hit, by the way, in this space, and probably some of you will know why that is. They were tied to one of those corporate bankruptcies that took place late last, actually I said late last year, but actually it was probably closer to the middle. That auto parts outfit in Ohio. I think that hurt them a little bit, but in general, I do like Goldman Sachs' money-making capabilities. Jefferies might be kind of interesting in the sense that it was beaten up on that negative news and therefore represents a relative bargain in the space. I was always pretty impressed with Jefferies as a secondary financial institution. And when I refer to secondary or even tertiary investment banks, I'm talking about the likes of Jefferies, and I'm talking about the likes of Cantor Fitzgerald, where I used to work. This is not a knock on those firms, but these are not white shoe investment banks that date back to the beginning of the last century. It's not Morgan, it's not Goldman, or anything like that. And a lot of these scrappy firms can, if scrappy is I don't mean that in any kind of a pejorative way, but Bear Stearns was such a firm also. And they obviously grew into quite a powerhouse before they didn't. That obviously turned out very badly in the credit crisis. But my point is that sometimes the growth opportunity in those firms is in some ways even bigger or better than it is at the number 1 or 2 slot, right? And the other point that I would make is that Morgan Stanley is less on the investment banking and trading side of late than Goldman Sachs is. They have focused their core business much more on asset management. That's fine as asset prices go up, but all else equal, if things get chopped up a bit, I think Goldman Sachs is going to be better positioned just in terms of trading and in terms of risk, because the fees for Morgan Stanley would be hit, of course, if asset prices decline. One thing I will say is that I think Morgan Stanley was actually positioning themselves fairly aggressively for some of the bigger IPOs that might be coming up. Now, I had actually talked about this on Fast Money. Morgan Stanley was very, very aggressive in getting the lead spot when Facebook did their IPO many years ago. And so people who were watching that episode of Fast Money were probably wondering, like, what is Mike babbling about? Because there were a couple things that came up that week that I thought were particularly interesting. The first is that on the day before the IPO, everybody who was on the air that day was asked, what did everybody think that the closing price for Facebook would be the next day? Now, I happen to know at the time that there were insiders at Facebook who were interested, in the very least, at hedging their positions. And I knew this because as a bank, we had been approached by some of them to do exactly that. We didn't end up getting a deal done because the corporation itself, the registrar, wasn't necessarily willing to give us a complete outline of every individual's specific holdings. So what that meant was that we had only the insiders themselves to attest to their respective ownership of the company, and the company itself wouldn't verify that ahead of the IPO. So that made it very difficult if we were trying to structure some kind of a hedge for them around that. The second thing that I thought was quite interesting was that also that was a very big issuance. They raised a lot of money. It was a $15 billion offering at the time on I don't remember exactly what the valuation was, but in light of all of that, I thought, well, that's a lot for the market to absorb. So the appetite for additional shares might be a little bit more limited. You'll remember that at various times, particularly at the end of the tech bubble in the late 90s and into the early 2000, the demand for IPOs was so high that it was very common for these stocks to, double on their first trading day or more. And so getting an allocation of an IPO, these things were very highly sought after. And what I was seeing from my seat was that there was plenty of stock to go around. This was not a situation where demand for the IPO shares was heavily oversubscribed. So on that last day, before the IPO, I made a comment that I said the stock I thought was going to trade $2, I think, over the IPO price. And that was the lowest estimate of anybody on the desk, but it was not low enough because, in fact, the stock closed the next day on the syndicate bid, which is where the banks can basically affect their green shoe option. And, essentially they were creating an artificial bid at the IPO price, and the stock just traded lower thereafter. But the other thing, so from the perspective of the issuer, this was a big win. And why is that a big win? Because you kind of feel like if you issue stock at an IPO price and the stock immediately trades at double that price the next day, you kind of feel like, well, I should have realized more of that money, because the IPO money goes into the coffers of the corporation. All of the secondary market benefit flows into the hands of the people who got it at the IPO price. So if it trades very close to the IPO price, then essentially you've maximized how much you were able to raise. From the bank's perspective, you probably want to have a little bit of a gap in there, just so that people want to come back for your next IPO. So there's a balance to be struck. But the other thing that Morgan Stanley had done, which I thought was very interesting, was that they offered to Mark Zuckerberg the opportunity, for his purposes, mortgages at 1%. Interest-only mortgages at 1%. So what does that mean? That means that if he wanted to buy $100 million worth of property, he could just call them up and say, I want to buy $100 million worth of property. He could buy it, they'd write the check, and he would owe 1% interest only on the principal, which is quite attractive. Now that is very powerful because, of course, if you live in a high tax state like California, it's appealing for founders to be able to essentially to borrow against assets and not have to sell assets and therefore realize taxes. And all of that plays into what's the big debate about the billionaires tax going on in California right now, which Gavin Newsom has now said he's going to try to shut down before it makes its way onto the ballot, and that if it does, he is then going to do his utmost to make sure that it is defeated. Okay, so Goldman Sachs, yeah, I think I kind of like it better than the money center banks here, but I also think that, whether or not there's going to, this credit card fee cap thing, it doesn't seem fully fleshed out, and my guess is that's not going to happen. So I have a feeling that whatever is coming out of those stocks in fear of that it's like many other things. We get this rhetoric that's coming out of DC, but there's probably some voices of reason that are suggesting that price controls of this sort might not necessarily be a great idea, and that even if they do put some form of a cap on it, and various states do have rate caps, but even if they do put some form of a cap on it, is it going to land at 10%? And my guess is probably not. After all, we did see peak CPI inflation of about 9.1%. During the Biden administration years, and what credit card issuer is going to be interested in unsecured revolving credit at 90 basis points over inflation? I mean, that's assuming that you could get back to that rate of inflation. But my point is that at 10% is just not tenable. That's not realistic. You need to have a higher rate of return to make lending unsecured revolving credit appealing. I mean, imagine if you had a 2%, full-on default rate in credit cards, and you had a 7, 8, 9% real rate of inflation. Then the returns on that revolving credit would be zero. So that's not realistic. FinWest. Good morning, Mike. I returned from 8 days in Vietnam yesterday. Sadly, I'm far behind on your replays, but we'll catch up soon. Thank you for keeping your channel content growing. Yeah, well, we're keeping at it, and we intend to this year. I have some other ideas for these that I'm working on, and hopefully we'll get more content out, and some of it's going to be more structured. Some of it's going to continue to be sort of open format like this, where we can take questions and work through problems together. But obviously, to any and all, if you have thoughts, you have suggestions on how we might improve this, by all means, put them into the comment below, and we will evaluate those in due course. James Forbin. Taiwan Semi reports earnings tomorrow. What is the expected move, and are the calls or puts more favored? Let's take a look. By the way, the results in general have been quite favorable so far. So is that really 3.5%? Okay, so relatively small implied move, although as we can see here, the one-day implied moves have been relatively modest. I'm going to expand this because that seems a little muted, and I'm wondering whether there's a timing mismatch. So we'll go like this. Yeah, let's pull up Unusual Whales and see what they've got. It's nice. We can also get a little picture. Log in. Oops. All right. I do have to make a habit of getting this thing booted up beforehand. Admittedly, I've not been diligent about that. And again, this is just stems from migrating immediately from a trading day into these live streams, and because I'm always looking at the Bloomberg terminal anyway. So let's see here. Let's get a ticker in here. All right, so this is what we're looking at right there. So if you're looking at this, trying to figure out which panel I'm looking at, it's this one here. And yeah, I guess so. We haven't seen really big moves over the last 3 quarters, but this is fairly large, I guess. You know, I mean, 10% to the upside, 10% to the upside. The worst downside move going back to Q1 2022 was a decline of just 5%. So in general, when we have seen moves that were larger than the options market anticipated, they were to the upside. Based on the results we've seen out of other tech names recently, maybe we can expect that to be true once again. But if we're looking at options volumes today, you'll notice that puts outpace calls somewhat. I mean, not by a huge amount. We'll call it a little more than 10%. 100,000 puts traded versus 90,000 calls. In general, call volume does outpace put volume, though. You will see over the last 20 days. But I would also point your time and attention down here. And what you're going to see is that actually the open interest in puts has generally been higher, and actually pretty substantially higher. You know, we're looking at maybe 80% higher than the call volume. So the biggest volumes that we're seeing were the 330 puts, essentially at the money, expiring in Feb. But look at this, implied volatility was lower. So this is opening. The February 330 put volume is opening, as was the 320s. We can see that over here. So if you're looking, just so, I mean, I realize there's a lot of numbers here. So I'm just going to point your eye to a couple things by highlighting it. So this is today's volume, 22,000 of the Feb 330 puts traded. The open interest is over here. So it's less than 1,000 open. So we know that was opening. But what we can also see is that implied volatility was lower. So let's take a look at this intraday and see, did this trade as a block? Was it trading throughout the day and was all trading lower? It looks like it all was trading in the morning. Right there. So knowing that, were those spreads by chance or were those outrights? We can see. So I'm going to look for trades. Let's see whether there were some really big pieces. All traded at the same time. So were there some institutional prints? There were. Electronic trades. Interesting. Okay. So I don't see these necessarily tied. That's over here. You see that condition code where it says ET? That's just an electronic trade. The letters next to it just refer to the exchange where the respective print took place. And so now our next step is going to be, okay, so we can see that about 9,000 of these traded around 942. So now what I can do is I can say, all right, well, what was the price of those options at the time that that order came in? And so we're going to go from the open to about 942. That's where a lot of the volume took place. And let's see if, okay, oops. So they were 1485, 1720. We're going to find out whether that was a buyer or a seller as soon as I can see where that first trade went off. So these are just the quotes every time they get refreshed. And unfortunately, because quotes, you know, this is drinking from a fire hose, as I often describe it. the quotes are refreshing. You can see that a lot, these, for example, all of these quotes that you're seeing here are all taking place at the same second. So if we were looking at this in milliseconds, we would see these quotes refreshing. But what we're trying to do is just get to when that order first started to hit the tape. I apologize if this is... I'm not trying to let anybody have an epileptic fit by seeing this thing flash or anything like that, but we're just waiting until I see a print or two, particularly a big one would be good. And then we'll be able to tell whether, all right, it's going to be coming up any minute, I would assume. There we go. All right, so 60 go off, 16.55. This is probably, yeah, this looks like this is the beginning of the trade. So that was actually a seller. So all of that flow, this thing was 16.55 bid, and somebody came in and started intermarket sweep. So you see this, IS, electronic trades. So basically what happened was an institution that had access to an algorithmic platform had thousands of these things to go, opening. So as we look at this, what you're seeing is put selling. So there was more, there was a lot of put volume in these things, but it was now I somehow ended up on a call over here. But these things were being sold. Now I can actually take a look and we can decipher this a little bit more precisely by saying, okay, let's just see what happened between 9:30 and 9:50. So about half of these contracts traded within the first 20 minutes of trading. These were sold, institutional seller, opening, at an average price of 16.55, which was the bid at the time. So in terms of flow, if you're trying to decipher, you're saying, okay, well, what does that mean? What is somebody else betting on? How do I interpret this? The short version is that these contracts were an institutional opening seller. So this is one of those situations, and I think it's worth going through the whole exercise where a little bit of information isn't necessarily telling you the whole thing. Because if I told you, you said, okay, well, Taiwan Semi's got earnings coming up. What were the two most active contracts? And I said, well, it's the February 330 puts and whatever the other one was. Let's just double check. The 320s, 330s and the 320s. Here, too, you can see the implied volatility was lower, which suggests those also were sold. We could go through the same exercise. I don't think that's going to be important. And I said puts outpace calls, double the average volume, and the most active options were the February 330 and 320 puts, institutional trades. Your immediate inclination might be to say, oh, so some big institutional trader has decided that they don't like it here going into earnings. But, a little bit deeper, we look at something like implied volatility. We can see that it declined. That's not necessarily consistent with a 22,000 lot of options trading. That implied volatility would go down if it was actually an opening buyer. So we suspected that it was an opening seller. We look at time and sales. We can see that the market was 16.55 bid at 17.5 or whatever the market was, and that electronic orders came in and hit the bid. So it was an institutional seller. Now we know. Does that person have any unique insights? Well, I don't know, but in terms of sentiment, we have information now that we were able to divine relatively easily. So you were asking the question, James, were calls or puts more favored? The answer is puts were more favored, but they were selling those puts, which is a modestly bullish bet. Okay, JBow, Lyondell Basel was up 6.8% today, reports earnings at the end of the month. Is buying a March 52.5 65 call debit spread and selling a Feb 45 put a good trade. So you are looking at a diagonal. That's basically a call spread risk reversal on Lyondell. I think that's fine. You're looking to do a little bit of a vol crush trade on the Febs. Let's take a look. And, you know, you're kind of getting to an interesting level right here, too, right? So we're right under the 200-day. Is it going to break out and sort of regain its mojo? I mean, it's already traded to the high side of the 50 and the 100-day. And let's go to Carter Worth's favored metric. Let's take a look at the 150. Are we getting into a potential bearish to bullish reversal here? Boy, whoa, we're right on the number. Right on the number. So the short version is, yeah, I like what you're doing here. And I like it for another reason, which I might as well get into, which is that you'll notice, for anybody who's paying attention here at home, that he is selling these 45 puts, which is in essence where the stock appears to be turning the corner from. So the downside is that you potentially own it down around this level, and then you're getting participation effectively from here up to there. So I do like that. I'm not 100% sure why you wouldn't consider. I mean, Feb's is a good expiration to sell. Just about 40 days to expiration, so I like that. I will say that your 52.5, 65 call spread, that, you know, that's going to have those options have a little bit more vega, right? So let's take a look at the vol surface, okay? Or actually, more importantly, let's look at the term structure first. And as we look at the term structure, you get this you get this situation where with the event, that's going to be the highest point on the board, and that's true here as well. But the other thing that I think is important to remember is that these marches, although they are somewhat lower implied vol, they have more vega. And normally what happens after the event takes place is you will see the term structure revert to something more normal, and the more normal term structure in general is going to be slight contango, so the vol surface is going to look a little bit like that. So these are going to come down the most, and these are going to come down the second most. These options here, which are the Febs that you're actually short, their vol is going to come down more, but the vega, that is that the option sensitivity to a change in implied volatility, is slightly less. So I don't even think it would be a bad idea necessarily to package it all into a single expiration if you chose. But if you're why would you do it this way? And the reason you would do it that way is if you're saying, okay, I think we are well and truly in a bearish to bullish reversal. I think the news is going to be good. I'm anticipating a vol crush, but I'm also expecting that the stock's move higher is going to take place over a longer period of time, and that's why I want to have those March options on. Then that would be the reason. But I also don't think it would be a terrible thing to have it all packaged into one expiration as well. So, yeah, but I like where your head is at on that. I like that trade. While you're looking at banks, could you give it your outlook on KRE, which is the regional bank ETF? I noticed it's consistently underperformed, but hoping that changes with 2026 consolidation. So, yeah, I mean, the challenge for regionals in part has been that there was a little bit of excess exposure to commercial real estate for some of the regionals. You know, local office buildings and things like that. I really feel like that's taking a long time to sort out. On the other hand, I kind of feel like it's about as bad as it's going to get. So I suppose in that sense, it's okay. You know, actually, bear with me a second. I seem to remember. Let me see if I can find this. I vaguely remember. I thought I saw a note on this. Did I? For some reason, I thought I saw a technical note on it from Carter or for somebody else that I'm on their distribution list. But Maybe I'm imagining it. I don't see it in my email. Sorry for that. So I do kind of feel that where the regionals are, that the situation can't really get a whole lot worse. So that's, I guess, the good news. Let's take a look here at the constituents of this index and just sort of decide what we think is... I mean, I'll admit that I have not really played that much in this space. Some of them have started to look... So they have been showing up on my screens, though. So let's go through that exercise a little bit. Let's just run the screen and see whether we can find a couple that are reasonable at the current level. So just going to look for things that are, you know, above their 200-day, where we're still getting some, maybe we're getting a little bit of acceleration in their trailing revenues and earnings over the last 5 years. Now, I'm putting, these are somewhat lower thresholds than I might otherwise put in. The reason for that being that I know that a lot of these institutions were relatively hard hit because of the pandemic. So I'm kind of looking at these saying, all right, well, I'm going to give them a little bit of the benefit of the doubt there. And let's do one additional thing, which is I just want to make sure we're not looking at anything where, because this does, over the course of 30 days, tend to have, you know, relatively bad, tests out very badly. So we're just going to ignore anything like that. And let's see what we have in here. This is a foreign bank, actually, so I'm going to ignore that one. Do we have any? Zions shows up in here. I knew there were a couple. So let's take a look at Zions Bancorp then. And again, I'm, you know, talking at this point about names that I'm not involved with personally, but it is cheap relative to its own historical valuation. Things seem to be stabilizing to improving on the revenue side, the earnings side. Remember what I said before about banks, that, you know, if you can get them at something close to 1x book, that's not bad. Now, it's a little bit more bad news in this space than the other, so they're going to trade at a discount. Remember that I think Jefferies, which was one of the names I said, you know, within the investment banking space, looked reasonable based on their turn at 1.3, 1.4 times book value. But 1.3, again, not terrible. And let's take a look at what we have for next year. So full year top line revenue growth estimated to grow at 4.7. Not terrible. This isn't something to get hugely excited about. 3.6% year-on-year growth, but it is trading at less than 10 times forward earnings, so it's not like it's pricing in anything. You know, it's not like it's grossly overpriced on a relative basis there. So I think if you're going to play in the regional bank space, based on this sort of very preliminary and cursory look, and I will endeavor to look at this a little bit more over the course of the weekend. You know, I admit that, you know, I look in one space, and that doesn't mean I'm giving all of my time and attention and focus to some others. And this is an area that hasn't been getting as much time and attention from me. But that's not terrible, right? And actually, it's a good way to think as investors, by the way. So I'm glad you bring it to my attention that what do we tend to look at? We tend to look at things that have been grossly beaten up that might be reversing. Basel, which was another name that you guys brought up that I think is a very good one to look at. We tend to look at the things that are performing well. Will they continue to be? Some of the things like this, where you kind of feel like, oh, there's secular headwinds, don't really like the space, and they've been kind of dead money. Maybe they don't get the attention that they deserve. This thing is basically right where it was a year ago. But, in fact, it's actually the same place that it was even 5 years ago, effectively, as we can see right here. But maybe this is a good time to take a look at it. It's not expensive, and it seems like the worst is seemingly over. So they're going to be, when are they reporting? They're reporting on the 20th. So that means we will have time to talk about it on Monday. Or will we? Did they report before the open? Or let's see what's going on here. Let's see. So that is going to be Tuesday. Let's see when they report. They're probably, given their headquarters, I'm guessing they report after the close. Let's check. Yeah. Aftermarket. Yep. Right here. So we will actually have time to talk about this on Monday. What holiday is Monday? You can tell I'm not just talking to you guys. I've got somebody in my ear. It's a federal holiday. Well, I mean, assuming that the production staff is willing to be here, I am. So maybe we'll do a little bit of an open mic on Monday, assuming everybody's available for that. And Zions can be one of the names that we take a look at. So, yeah. MLK, market's closed. But that means we still have a full trading day of Tuesday to look at Zion. So I'll take a look at that. So far, you asked me a question off the cuff. I didn't have an answer off the cuff, but we kind of fumbled through it together, or you watched me fumble through it. In the regional bank space, I think Zion's looks interesting at first blush. Let me do a little bit more homework and come back to you on Monday. We can talk about it, and we'll still have a little bit of time before they report after the close. Okay. Tucker D. Dog, credit card scheme not fully fleshed out. What Trump plan has been fully fleshed out? Yes, indeed. This is not something that I think we're very used to in American political life, because politicians tend to be so deliberate and they say so much and say so little at the exact same time. Rarely do they just throw things out there off the cuff the way he does. I'll admit that it's not what we historically think of as very presidential. And I'm not enamored of every idea he has, and I'm certainly not enamored of the way the rhetoric that surrounds this whole thing in Greenland. But there are aspects of his behavior that I admit I prefer to some of the other ways, which is that he does seem to say what's on his mind, whether it's a little zany or not. Sometimes we like to hear from people and actually know what's going on inside of their head instead of having them tell us something that we know they don't actually believe. Like I said, I don't believe the 10% rate cap for credit cards. Whether he wants to do it or not, or changes his mind, who the heck knows. What I believe, though, is that it's not tenable. It's not realistic. It's not a good business if they did that. And one of the reasons I like Goldman Sachs over JP Morgan is they're kicking that problem out the door, and that becomes JP Morgan's problem now, because Goldman's not going to do it anymore. So, I mean, I don't know that the day is going to come that we're going to get politicians that both speak their mind, sort of lay it on the line and tell the truth, and also have full. are have fully fleshed out, fully baked, rational ideas. That might be too much to hope for, I guess. Okay, so Kalel on the Move. Whatever happened to Options Action? It was a really good show. I enjoyed doing Options Action. I did it for, I think, 16 years, from 2009. We didn't have it last year, but I think, when did it end? 2024? Yeah, so from 2009. So quite a while. What happened was there's been a lot of consolidation in the industry. Everybody watching is aware of this. That show was kind of the brainchild of, and initially sponsored by, and the two collaborators were the executive producer Maxwell Myers at CNBC and Tom Sosnoff, who was the founder of Thinkorswim. So Tom founded Thinkorswim, and it was his idea that there should be more programming that was tailored towards those that like to use options. And he was they initially sponsored that show. Thinkorswim was ultimately acquired by TD Ameritrade. And even after Tom left TD, they continued to sponsor that show for many years thereafter. And then TD itself was acquired, this time by Schwab. And there was a contract in place, but when that ran its course, they did not renew it. And I think there are a lot of people who missed that show, and I miss it a bit myself. But I know that the people who were, key to its creation, have designs on bringing either that or something like it back to CNBC sometime soon if they can. Hopefully with some improvements. So we shall see. I would say watch the space and stay tuned. All of this is, the landscape has also changed a lot. So when I first started doing that in the mid-aughts, most business news programming, analysis, things like that, came from linear television. That is to say that it came from Bloomberg Television, it came from CNBC Television, perhaps it came from Fox Business a little bit. Fox Business was not as big then as it is now. And what has happened since that time is we're doing more things like this. There is more sort of direct-to-consumer, interactive live streams where the audience can interact with the rest of us. And my guess is that if they bring something like this back, the people who are involved with media, this is not lost on them. In fact, they know and have forgotten a lot more about digital media, linear television, print media than I'll ever know. So my guess is that if a product like that comes back to market, it is going to be a more vertically integrated, bit of programming, which would include everything from real-time alerts to interactive programs like this one, to data and analysis, to linear television, and all the rest of it. So my guess is we will see something like that. Will it be called Options Action? I don't know. But this is also one other quick point about options, and that is that the compound annual growth rate of options volume has vastly outpaced that for equities for at least the last 25 years. So this is growing more rapidly than equity trading volume is. Investors are becoming more educated than they used to be because the information's right there, and you have a lot more tools at your fingertips. So it only makes sense. And we can also see how important this is to the banks and brokers that service accounts. Look at Robinhood. Look at Public. Look at even Schwab. They acquired TD Ameritrade for a reason. TD Ameritrade acquired Thinkorswim for a reason. Those things were platforms that focused heavily on options. Those are platforms that focused heavily on education. And they focused heavily on self-directed, and we'll call them prosumer type investors. So CNBC knows this. They have a new head over there. Smart guy came over from Dow Jones named David Cho. I think he's in charge at this point of both digital and linear. My expectation, they're probably going to come out with something good. So keep an eye on them. I'm sure there will be more there. James Forbin, yes, you're pointing out that Monday is a Fed holiday, but we'll be here, and you'll be here. Great. Mike, LW looks better now that the people must like it since since people line up to buy them at McDonald's each day. Lamb Weston, this is an interesting one because, wow, has this thing just gotten whipsawed. This is not the kind of business that you would expect to have these kinds of big price gaps like this one did. Because what do? They sell potatoes, right? This is not, you wouldn't think this is a hugely volatile type of business. But lo and behold, and this only tells part of the story because I'm going to go back further in time. You're going to see there's some other really big gaps. This thing has really bumped around over the course of the last several years. Let's go even further back than that. Who would have thought that if you're in the potato business that you would see something chop around the way this one has? I will say, Michael Anthony, to your point, that it does feel as if this is, whenever we have these kinds of setbacks, it's kind of in this neighborhood. We're getting back to, look at this. We're getting back right now. We're bouncing around on the COVID era lows. And the COVID era lows were really important when you think about it from a fundamental point of view. Why? Because during the COVID era lows, they were contending with the fact that you couldn't go to restaurants. Basically, you couldn't buy their products. It was, banned for a period of time. So is it even possible that the business could be worse looking forward from here to where it was at that time? Well, let's take a look at their fundamentals and or at least their pro formas and whatever else we have access to and take a look. So, their fiscal year, as you'll observe here, doesn't adhere to the calendar year. So I only point that out because, as you know, I generally look at, the next 12 months worth of earnings when I'm looking at multiples. So in this case, this number actually goes out to May. So we're not going to do that. I'm just going to pull this up to quarters, and then we're just going to add those together. And we're looking at $1.26. $1.25, $1.26, $1.90, $1.91, $2.66. Let's call it. Is that what we're looking at? Yeah, I could. $3.66. Is that right? What am I doing here? No, that's $2.66 a share, right? Let's use the calculator just so I can. My addled brain this afternoon. $2.66. Yeah, that's right. Okay. So 16 times forward, we've got 200 round numbers. What are we looking at in terms of free cash? It's got a decent amount of debt, this thing. I think we're going to take a look at the maturity schedule on that in a second. I'm curious what their debt is saying, but we've got 12. And I know that you guys watch me doing this. You're like, how the heck is this guy using this antique calculator to do his work? What can I tell you? Old dog. That's right. My producer told me I misplaced my abacus. We did have one of those when we were kids, by the way. So free cash flow yield is not exactly stellar. The top line growth is definitely not so stellar. It is trading at a relatively cheap turn to forward earnings, but based on those other two things, I think that's justified. All else equal, so let's just go back as a reminder for anybody who's watching who hasn't seen me before. you would know that this is probably not going to show up on the screens that I run. And the reason is that I kind of feel that you should pick stocks that you think are going to grow at least as fast as the economy, at least as fast as inflation. I like strong balance sheets. I like high free cash flow yields. And this one's not really hitting too many of those. The only thing that this hits that makes it tempting is that, well, maybe it's this stock is a little bit like the product they sell, French fries. It's tempting. It's cheap. So therefore it's tempting. But is it healthy? I mean, is the company healthy? When we should be eating salads and things like that, this doesn't qualify, and it doesn't qualify from a stock perspective either. It's kind of in that same thing. But every now and again, that's okay. I think it is all right to make exceptions. The CIO that I work for, his attitude is that you have a little carve-out, what he calls special situations. Now, special situations can mean different things in different contexts in investing, so I just want to lay that out because there are what are called special sits funds. Those are funds that sort of focus on things like corporate actions and other unusual things going on. But in this context, what we're referring to are stocks that don't adhere to our broader investment philosophy, where we're going to say, okay, you know what? I know it doesn't meet my growth metric. It doesn't meet my free cash flow metric. But I kind of feel that it looks like it's bottoming out here, and how much worse can it get based on its price to earnings multiple or something like that. So I'm going to take a little bit of a punter in violation of my broader rule set in small size to sort of satisfy that craving to buy cheap stocks. And that's, I think, the situation that you're looking at here. I would just quickly point out for anybody who's paying attention to that, we're looking at a 14, almost 15 times forward price to earnings multiple. This is the range, though, that this name has typically traded in. And what you can see is that this thing has actually traded down to a very cheap turn. So the 2-year lower end of that range, so that's not even going back to that pandemic plunge era multiple. If you go back to the 2-year low, that's still a 35% discount to the current stock price. I'm not saying it's going to get there, but that would be, a price of around $28 a share at the lower end of its 2-year multiple to forward earnings. This is another one I'm going to take a closer look at. And the reason I need to take a closer look at it is because, as you guys know, I start my day every day by doing the same types of screens. What's percolating to the top? What has fallen off? And none of these names, not regionals, Zion's is just barely in there. It could be justified, but it hasn't hit my sort of growth metrics that I usually look at. This one would never hit my screens based on its pace of growth. But I don't mind looking at them. I think there's good utility. It's a good exercise. So that's another one for us to discuss on Martin Luther King Day, which is next Monday. That's the next time we're going to do one of these open mic videos. And until such time, I thank you all for watching. I thank you for your comments and for your thumbs up and subscriptions. And I look forward to talking to you then. Thanks for watching.